In this video, I want to highlight the correlation between elections and the stock markets. Elections and the stock markets, what every investor should be familiar with. Political events, particularly elections, have a significant influence on the stock markets, on the stock market performance. This is due to the uncertainty and potential policy changes that elections can bring. Below are the key ways elections impact the stock market. Number one is uncertainty and volatility. Uncertainty and volatility. So in the pre-election periods, market often experience, increased volatility in the months leading up to an election, as investors try to predict the outcome and its implications for policies such as taxes, regulations, and trade. Then for the post-election period, once results are announced, you discover that the markets may either stabilize, or react sharply depending on whether the outcome aligns with investors' expectations or not. Number two is policy expectations. Policy expectations. So consider pro-business policies. So a candidate or party expected to implement business-friendly policies can lead to positive investor sentiment and market rallies. So for regulatory changes here, expectations of strict regulations or higher taxes can cause a decline in affected sectors such as energy, technology, and healthcare. Number three is sector-specific impacts. Sector-specific impacts. So different sectors respond uniquely or respond differently to anticipated policies of candidates. For example, in the healthcare sector, this may see volatility if reforms, to insurance or drug pricing are proposed. And not only that, in the energy sector, it can react to policies on renewable energy, subsidies, or fossil fuel regulations. Number four is foreign regulations, foreign relations and trade policies. Foreign relations and trade policies. So elections might, alter. It might alter a country's stance or international trades or relations, and this can impact global markets, particularly industries dependent on exports, imports, or global supply chains. And not only that, please subscribe to this channel and like this video if you've not done that. It will go a long way in encouraging me to bring contents of this nature that is designed to make you a better investor, to obtain financial freedom, and to be able to accumulate generational wealth. Number five is market trends. Market trends. So historical trends like the presidential election cycle theory suggest that market performs better in certain years of a president's term. Example, the third and fourth year, are traditionally stronger. Well, it's a theory. I don't know whether it is quite proven, but let's take it at face value. So election year performance. The markets may rise close to election day if investors feel more certain about the outcome or are kind of optimistic, about future policies. Then number six is global reaction. In countries with significant economic influence, such as the US or maybe other countries with global influence, election can affect global markets. Investors worldwide monitor outcomes that might reshape trade agreements, monetary policies or geographical stability. So we should not forget, number 7, behavioral factors. So in countries with significant economic influence, elections can affect global markets. Investors worldwide monitor outcomes that might reshape their trade agreements, monetary policies, or geopolitical stability. These are what we need to take into consideration. That's a global reaction to elections and stock markets. So we want to talk about, how investors react. Number 7, how do investors react? Retail and institutional investors may overreact to elections news, causing short-term price swings. And this reaction can be influenced by media coverage and sentiment analysis rather than long-term fundamentals. So in this case, discover that everything is governed and controlled by sentiments, by emotions and feelings rather than logic, rather than something substantial like the company's fundamentals, its balance sheets, its income statement, as well as its cash flow. And so the key takeaway here is quite interesting. You discover that while political events like election bring short-term volatility, long-term market performance is more closely tied to economic fundamentals than political cycle. As an investor, please take note of the fact that though elections may play a key role in the market, it's simply a short-term event. That is the post, election cycle periods, as well as the pre-election period. But in the long term, over years, many years, discover that events in the market are essentially driven by fundamentals rather than elections or other short-term, what I could consider as noise in the markets. And so don't be overly be inclined towards how affect election affects markets. Be so much concerned about the company's fundamentals essentially. Investors should maintain a diversified portfolio. It's very, very important. Maintain a diversified portfolio and focus on long-term goals rather than reacting to political noise. These are considered as noise because they come in and then they at a point in time they tend to disperse or disappear. So focus on companies' fundamental and diversify your portfolio. By so doing, you are good to go.